all for attending the session. So the whole idea of today's session is how we should plan for the investment allocation. Considering we have seen a lot of market volatility, keeping into the mind the way US China issue is happening with Russia, and also what we have seen geopolitical issues across the world. So one thing what we have seen that today that globally things are going to become much more volatile, and as we go forward, we need to plan in a way that certain investment needs to give more clarity in terms of return perspective. That's a whole idea for today webinar. We are looking to identify the investment options where you have a more visibility and chances of getting better return compared to the normal investment option. So if you look at two options, what we are looking at, one is SIF and second is structured product. Just to give a brief about SIF, if you look at, I think this financial year, SEBI has come out as a new structure for mutual funds where they can have a scheme which is completely have a combination of option of mutual fund and benefits of AIF and PMS as a SIF. The whole idea of creating SIF as a new investment option through mutual fund route, so that as individuals who are looking at better risk adjusted return. So that's a one thing which I want to make it clear that SIF is not just for high return perspective. The idea of SIF is that how as an investor can have a better risk adjusted return where their risk will come down because of the flexibility as an investment option level. Also, secondly, to make sure that as a investments they have a more flexibility in terms of investing perspective. So if you look at SIF, I think it's a mix of mutual fund in terms of as a pool investment assets and have a taxation similar to mutual fund. But if you look at have the benefit of AIF where they can have a derivatives to hedge the assets on a overall perspective. So if I look at what are the different options and how SIF is different compared to other investment options, so I think the first major difference, if you look at what most of the investors have seen that on the investment amount perspective. So SIF 10 lakh is the minimum investment amount which can be spread across different strategies. For mutual fund, it can be start with any amount, even 100 rupees. PMS 50 lakh and AIF 1 crore. So if you look at the whole objective of SIF is that clients who cannot have 1 crore of a corpus to invest in AIF category 3 investment, they can look at SIF as a one option. Secondly, from a taxation perspective, category 3 are almost like at 39% tax, wherein in case of SIF, because it will be at a fund level, so the tax liability after 2 years will be 12.5%. So that is the one thing where it is going to work better even in a debt scenario. And in case of equity, it is 12.5%. So the whole objective of SIF is that it's a more cost efficient. Also, from a tax perspective, it is tax efficient, and because investment amount required at a lower side, that give us the overall flexibility also to spread the investment into different investment option. And the most important thing, if you look at here, SIF to AIF, if you look at in SIF case, there is a 25% derivative exposure is allowed for the hedging perspective, and plus hedging can be done. So unhedged will be 25%, but there is no leverage allowed. So if you look at the major difference, AIF and SIF will be in AIF case leverage is allowed, but SIF leverage is not allowed, which is, if you look at from an investor perspective, it is a good thing because leverage come with their own risk also. So if you look at what are the different options of SIF which is allowed. So if you look at on an overall perspective, on there are three different category under which SIF is allowed: equity, debt, and hybrid. So if you look at on equity side, equity long short, equity excluding top 100 long short, which means technically predominantly mid and small cap oriented, and third is sector rotation long short fund. So which the sector rotation fund, the whole focus is how to invest into a different sectors where certain sectors fund measures bullish will be long, and certain sectors where they are not bullish they will be a short. So these are the three on the pure equity side. Debt side, there are two: debt long short and sectorial long short. And hybrid side, active asset allocator long short and hybrid long short. If you look at this point of a time, which are the two major category of SIF where we see going to come the highest interest. One is equity long short, because that is something where as a fund manager have a flexibility to go even short in the market up to 25%, and even he can hedge their position. Secondly, the hybrid category level hybrid long short fund, because in hybrid long short fund the idea is that how it can deliver compared to debt 2 to 3% higher return post tax perspective. So if you look at the overall perspective, we will also focus at this point of a time only in these two strategies, because we think these are the two things which is going to work very well from a long term perspective, because equity long short fund will give an advantage during the downside. So because most of the time what happen when you're investing like normally in mutual fund, so whenever market move up, your mutual fund or PMS will move up, but when markets goes down there is no downside risk protection. So that is a benefit what you will have in a equity long short fund, because it can do using derivative hedging also. So if you look at what are the three benefits majorly on the SIF, one is I think reduction in the volatility, because overall SIF have a flexibility to use derivative to hedge the portfolio, apart from using different strategies to make sure that overall risk is on the lower side. Secondly, if you look at it is enhance diversification and reduce the drawdown. The reason is why SIF will work better, because whenever markets are going on the downtrend, as a fund manager have a flexibility to do hedge the portfolio. So that is something which give benefit in terms of reducing the drawdown. Also, the third is I think it is the additional alpha, because as in SIF they have all sort of a option in terms of hedge the portfolio using different strategies. Also, take the benefit of different corporate actions, like for example, investing into pre-IPO, QIP, and all other things. So that way, it is help for additional source of alpha also. So if you look at why suddenly, if you look at SIF and a structure product become essential for the portfolio. So if you look at, there are times, I think that's a one thing which most of the investors are not realizing, that we have seen a period where markets have not given a return for very long period of a time. So that is the one reason why we say that we should not just look at the past return and think that okay, in last 5 years we have made 15% plus return, so same way it will continue. So the whole idea of these investment is that if for a longer period of a time, if returns are not on the higher side, at least these alternative option can give you the better return. Secondly, it will protect the downside risk, so that when your goals which are nearby, it should not get impacted because of the market volatility. And third, and the most important part, if you look at even from Indian market perspective also, because there is a lot of liquidity in the system. If you look at in India also through SIP, lot of liquidity is coming. So what is happening today, that markets are not going down, but they're not going up also significantly. And valuations remain stretched. So even today also we are around the long term averages of the valuation side on the PE side. So we are around 23 PE around. So that's a one thing what we have seen that going forward also instead of market correcting, it will consolidate, and that is where these type of products help to generate the alpha. Also, if you look at the overall yields from a fixed income instruments also going down, because as we have seen that in India also RBI is looking at further rate cut. So at those point of a time for investors who are looking at returns which are better than FD, it make a lot of sense from a SIF or structured product perspective. Secondly, from a tax angle also, they are more tax efficient in case of SIF. Also, if you look at the way volatility has increased because of geopolitical issue, if you look at last 1.5 year to 2 years, the way Trump is doing the policy level changes, Russia-Ukraine war, a lot of global issues. So that is something which is giving these option as a better potential for an investor perspective, so that they can hold their investment for a longer period of a time instead of taking a exit before reaching to their goal. So I'll just talk about two of the SIF option here. So first is the equity long short investment option, wherein as a fund manager have a flexibility to go 25% short as an investment perspective. So if you look at, for example, here, technically in equity long short fund, as a even being as a equity category fund manager is bearish on the market, he can have the complete allocation in a debt and doing a minus 25% allocation towards short. So which means it can protect the complete downside of the portfolio. So same way when as a fund manager is bullish on the market perspective, it can continue to hold is the long position. So the idea of equity long short investment option, if you look at, predominantly to protect the downside, because whenever as a fund manager see that there is a chance of market going down, they will take exposure on the short side, and they will hedge their current position. But one thing which we have to understand here that it may possible that fund manager may not be right all the time. So as a concept, yes, it give a flexibility, and it give a fund manager better view that he can take a call on their investment. But at the same time, the risk associated is that may not be investor will able to get the benefit of doing all the time. So we have to be very cautious in terms of selecting the right fund, because end of the day that is going to make a lot of difference in terms of how as a fund manager is taking a call on the investment perspective. The second option, I think, which I believe is one of the most used option in the category 3 AIF, that is a long short fund, wherein the idea is that how to get a better return than what as a debt fund can give. So idea is here is that to get 8 to 10% return on a overall basis on a post-tax perspective. If you look at that is 8% we can expect on a post-tax basis. And how it is going to work, so there are multiple things which is being added. So focus, if you look at, including arbitrage, fixed income, special situation, and the derivative strategies. So combine these things help to deliver better returns. So if you look at in the long short on the hybrid side, the pure equity allocation will be on a very lower end perspective, predominantly 40 to 60% on a fixed income, 20 to 40% on the arbitrage and covered call, special situation maybe up to 10%, and 10 to 20% on using the derivative strategy. So the whole objective of long short fund is that to get the better yield in a longer term perspective. And this is a back test if you look at in terms of one of the strategy on the long short, how they have delivered. But one thing which we have to understand here that even they use best of the strategies, but in short term you may see some sort of a downside also possible. So that's a one reason which as an investor we have to make sure that if we are doing investment even in the long short fund, at least keep a 2 year plus of time horizon. So if you look at in a 2 year level average return, we can expect 10%. On the upper side it can go to 12 to 13%. So as a strategy it worked better, but as I told earlier that not all the time whatever the calls as a fund management take, it may not go right all the time. So there could be a short term volatility and negativity, but in a long run I think it is one of the best option to get returns which is better than debt. If somebody have a 2 year plus of time horizon for the investment. One thing which we have to make sure that on the hybrid side we keep it more than 2 years of the allocation, because then only we get the benefit of equity taxation, which is 12.5% post 2 years. So idea, the first strategy of the equity was more to generate higher return perspective, and the hybrid long short is idea is more that to get better return than debt with lower risk. And this is the overall comparison. If you look at in terms of different investment option perspective. So if you look at debt or even arbitrage or equity saving category. So overall perspective, I think if you look at SIF is coming out on a better place. And secondly, if you look at in terms of the standard deviation, which is on the lower side, even keeping into the mind very lower allocation of the equity, because if you look at in compared to equity savings the overall equity allocation is very low. So it's a good option if you look at from an investment perspective. Only thing view has to be from a 2 year plus, and we can expect up to 10% type of a return as the average return perspective. And what are the different options they use, how they're able to create the return. So I thought just to cover up some of the options, like for example one of the option they use that called covered call, wherein they buy this whatever the stocks they are holding, they sell the call option and that generate the income. So that is another way wherein they create a regular income from the portfolio. So for example, if as the fund is holding Infosys shares, and it will sell the call option of Infosys at 1480. So technically, he's earning that premium, which is 7,500 for 300 shares. So same thing he can continue to do on a longer period of a time every month basis. The only risk here is that, for example, if Infosys stock move up, so the overall net gain will be on the lower side. So most of the times fund manager use these type of option to generate additional return, because even as stocks which are not doing good in a short term perspective, still they continue to make return using the derivative strategy. The second strategy, which normally which has been used, that where markets are not moving much, so they sell the call and put at the same strike price in its expiry and get the benefit of the premium, which technically give them benefit in terms of earning the premium. These are the different strategies how they are able to generate the return. Then third is the short straddle, wherein they, if you look at sell the out of the money call and put option to make sure that even they don't lose out significantly, so their profits are limited here, and in case of any larger correction then only it get impacted. So there are multiple way through which, even not to take very high risk, fund manager can create additional return, but for that they need a very strong expertise on derivatives. So I think the most important part here, the fund selection, is very critical. And the last one of the strategy, what they call, that's called pair trade, where, for example, they will buy one stock in a same segment and sell it, and the difference they will make as a return perspective. The next part, which I'll talk about, is called MLD. So I think the whole objective of creating this option is that how we are able to get the protection also on the capital side and some of the option and get the growth also. So if you look at that, typically there are two type of market linked debentures. One is principal protected, second is non-principal protected. And if you look at from a risk perspective, typically they will be lower risk than the equity, but higher than debt. So predominantly idea is that to get the better return than what debt can give, and from a risk perspective, lower than equity, and return perspective, it can go as high as equity, even more than that. So if you look at what are the risks associated with market-linked debenture, I think the first and foremost is the market-linked debenture will have a market risk in terms of their returns are completely linked with the index. So for example, predominantly we look at either Nifty or a gold, for example, for market-linked debenture. So based on their returns will be decided. Secondly, the credit risk, because they are issued by corporates. So for example, if you look at like Anand Rathi, Incred, Edelweiss, they are the three large players who are into market linked debenture. So the most important part is to understand the issuer risk based on the overall rating and the overall comfort financial perspective with the creditors. That is something which can be the deciding factor to look at which MLD to look at. Third is the liquidity risk, because these products are for a fixed duration. So if you look at most of the MLDs are either for 2.5 year or 3.5 year perspective. So and there is no in between liquidity. So anybody who's looking at investment into the MLD, he needs to make sure that he can continue to hold for that duration. Otherwise, he will not be able to get the benefit in terms of the return perspective, because it is a completely lock in. He cannot take out the money. And from a taxation perspective, I think if you look at it will be a short term capital gain on the overall perspective, and it will be taxed as per the marginal tax rate of the investor. The one benefit, if you look at that, it can be offset against any short term capital loss if investor is having. So there are two options which we are looking at this point of a time from allocation perspective for the investor. One is on the gold side, where we have a view that if you look at last 3 years, gold has run up. So the overall upside may be a very limited, but gold as the overall allocation perspective is a good investment option for up to 10% of the portfolio. So if you look at the all-weather gold option, wherein it gives 52% return if gold give move more than 10% on absolute level in next 3 years, and principal is protected in the downside risk perspective. So technically, if you look at as an investment perspective, it is giving the upside up to 52%, but it is capped. And how the entry and exit level decided, predominantly whenever as an investor they are entering, the average of the initial 6 months, and during the exit, the 31st month to 36th month is the average for the gold price perspective. So this is the overall payoff structure for the market linked debenture, how it works. So if you look at if gold is giving the negative return, still as the investor he will get the invested value. But on the upside, their upside is up to 52% if gold returns are more than 10%. But there is a cap. Even gold give more than 52% return, still the upside will be limited to 52% return. So market linked debenture, if you look at, there are multiple strategies. I've just given a two examples. So the idea is that they create a clarity in terms of what is the expected return could be. So if we look at here, the overall IRR will be 12.71%, wherein if gold give more than 10% absolute return in next 3 year perspective, and it protect the downside risk. So it's a good option for an investor who is looking at to diversify the investment, but ready to take some sort of a risk in terms of holding and looking at the right product option perspective. The next option, which on the Nifty side, what we are looking at this point of a time, that Nifty beta, wherein our view is that from here next 3 years, market should do well, considering there a lot of consolidation happened last 1 year, and the way if US and India tariff deal gets sorted, I think at least we can expect a overall good up move from a next 3 year perspective in the market. So in this case, it give 1.5x return compared to what Nifty give the return. But on the downside, it will have a similar what index give. And same way for the calculation for the entry and exit. So initial 6 month will be considered as a average as an entry level, and for exit 31st to 36 months. So the most important part here that it give 150% of the Nifty. So overall, our view is that from here next 3 years we can see Nifty going up by 50%. So technically, if you look at on an annualized basis, it could be 12 to 13% average return. So if Nifty give 12% on annualized on absolute level in 3 years, it will be around 50%. So in that case, we can expect as a product it can deliver 75% return, which will be almost 17% IRR. So that way it make a lot of sense from an investor perspective that it give a visibility of better return compared to what Nifty can deliver. On the downside, it will have a similar what Nifty is giving on the downside perspective. The reason why these products are able to deliver higher return. So if you look at as a MLD as a concept, if you look at whatever money as an investor give, 80% of the money of that they use for their lending purpose. So for example, if investor has given 1 lakh, 80,000 will go for their lending business. The balance 20 rupees they will use for buying long dated call options and put option to create a strategy which can create a payoff as per the index movement. So if you look at out of 100, the 80 rupees which is given at a 9% return, also it will become 114 in 3.5 years. So that 80 becoming 114 plus the option payoff will make sure that investor is able to get similar return. So the whole idea of the structured product is that as an institutional they have access of creating options which are long dated, and it give a visibility to the investor also that what type of a return they can expect from an investment perspective. And even if you look at on a post tax basis also, for example in even in the Nifty beta case also, it comes better than what Nifty deliver, even somebody who is in a higher tax bracket, because the return difference is almost like a 1.5x. So ideally we don't suggest very high allocation. It should not be more than 5 to 10% of the overall allocation for the investor. But these options are becoming very popular. If you look at globally, also structured products are a very major allocation for the investor. In India also, slowly these investment options are getting evolved as markets are becoming more volatile, and investors' major investments are towards financial assets. I think that's all from my side. If we have any questions, I think we can take it.